Welcome to the Roundup, covering what's important to accountants and advisors across the month of June. Inside this month, we're looking at the issues arising in practice with family trust elections. We'll also look at the ATO's warning to employers on superannuation guarantee obligations, plus also an interesting case that looks at a valuation contested by the ATO for a taxpayer accessing the small business concessions. But first up, as you know, Parliament sat at the end of June, and one of the bills they were looking at was the long-awaited Support for Small Business and Charities Bill. Long-awaited because this bill contained the changes to the instant asset write-off thresholds for 23-24. Plus also it contains the reforms to the non-arm's length income rules for self-managed super funds. But if we look at the instant asset write-off, despite the haggling between the House and the Senate, the final position of the bill that's now being passed is that the threshold has increased from $1,000 to $20,000 for the 23-24 financial year. Plus, it's also accessible to small businesses up to $10 million. So pretty much as it was announced in the federal budget. And if we look at the gnarly reforms, this limits the amount of non-arm's length income for general expenses. Now, these are the expenses related to the fund as opposed to related to very specific assets inside the fund. Under these reforms, the general non-arm's length expenses will result in a maximum of twice the difference between the amount that would have been expected at arm's length and the amount actually incurred being treated as gnarly, with no deductions applying against that income. Now, for accountants and advisors working with SMSF clients, we have a very practical webinar coming up on Wednesday, the 17th of July, to take you through the application and also the issues that arise as a result of these new rules. Now, aside from what's going on in Parliament, the ATO has been very active highlighting problem areas. One of those is family trust elections. A new update looks at the problem areas and where these are occurring inside practice. Now, when we say update, we really mean warning. Now, Michael, what are the issues here?
Yeah, well, the family trust election space is a very complex one. And over the years, I think I've come to realise that it's an area that is way more complex than maybe what I first thought when I came across these rules a little while ago. Dealing with family trust elections is something that you need to have not only a short-term focus in terms of often family trust elections are being made to fix a short-term problem, but you need to have a long-term view as well. Because we need to be aware that making that election can have very long-term ramifications for clients into the future and across generations. Now, family trust elections, just kind of taking a step back, family trust elections effectively allow trusts that make one of these elections to access certain concessions within the tax system. The most common reasons why someone might think of making a family trust election are to improve access to tax losses that might have been generated by a trust, or to allow the benefit of franking credits to flow through, particularly a discretionary trust, to the ultimate beneficiaries without failing a holding period rule that would otherwise be often quite difficult to satisfy. A couple of other reasons that you might make a family trust election: sometimes get better access to some rollover relief, but dealing with losses, dealing with franking credits, for a lot of people, that's the driver behind making that election. The downside, however, to making a family trust election is if that trust distributes outside the family group as defined in the tax system, then that triggers family trust distribution tax. Basically causes the trustee to be taxed at penalty rates on the distribution that's been made. The thing is that once you have made a family trust election, it can be very difficult to change that or get rid of it later if you realise that either you shouldn't have made it or you wish you'd have made it a little bit differently. And so that's why this can be such a difficult area, because once that election is made, it can be very difficult to change, can be very difficult to remove, but it can then have very serious flow-on implications into the future. When making a family trust election, generally we won't make one unless we really, really need to. So don't just make it because it might be helpful one day. Figure out whether you really need it right now. And if you don't, I'd caution against rushing into making that family trust election. The other thing we need to think about very carefully is who are we going to use as our test individual or our specified individual. It's that individual around whom the family group is defined. So we pick a particular person as a test individual, the family group, so the group of people or entities that we can distribute to without triggering that penalty tax regime, is defined with reference to that person. Now, if we get that wrong, it can be very difficult to change that. Sometimes we can do that as a one-off, but there are time limits for doing that. So once you've done it, you're often stuck with it. So need to make sure that we're being very careful with this. The ATO notes in the guide that's been released over the last month or so that we need to make sure that we don't forget that family trust elections have been made. We need to make sure that there's a good record on file of the fact that the election was made, when it was made, who the test individual was, and if we're making a retrospective election, which is something that we can often do under the rules, that we're aware of when the start date for that election was and the impact that might have on our ability to either remove the election or vary the test individual later. So a lot of things that we need to be aware of, and this is an area that we need to be very, very careful about.
Are there any other things we should be aware of when we're using family trust elections?
There are lots of problem areas that we need to consider or that we need to mitigate or avoid when dealing with family trust elections, but there's just a couple of things I wanted to touch on as part of this update. The first one is dealing with family groups, and it might be extended family groups, where we might have multiple trusts making family trust elections. One of the things that can cause massive problems and ongoing problems into the future is where within a family group, we have various trusts with a family trust election and different individuals within that family group are used as the test individual. So we might have person A as the test individual for trust A, and person B as the test individual for trust B. Now, they might be very close relatives and they may well be within the same family group, but the fact that we have used different test individuals for those family trust elections can end up causing some very serious and ongoing problems. For example, it can make it very difficult for certain companies or unit trusts that are what we might think within the family group to be classified as family group entities for the family trust election rules. So that's something we need to be very conscious of. In practical terms, it will often be cleaner if we can just pick one individual who is used as the test individual for all of the elections that are made within the group. But sometimes that's simply not possible. Sometimes someone else has already gone and made the elections with a certain individual or with multiple individuals, in which case we might be just stuck with that. We might just have to live with that and try and work around that. You might have a scenario where an individual has traditionally been used as the test individual within the particular group, but they've since died. Well, we now can't use them as a test individual for future family trust elections. So we're going to find ourselves almost forced to use a different test individual if we do want to make further family trust elections. So sometimes it's a problem you can't avoid, but if we can avoid it, often that is probably the way to go. Again, thinking through long-term potential problems, potential planning, as well as any short-term issue we're trying to deal with. The other thing that crops up quite a lot in practice is we can end up with a lot of problems in this space when we are dealing with companies that have different share classes. When you have a company that has different share classes, that can make it very difficult for that company to form part of the family group of a particular test individual. And just for example, what that might mean is that if we ever wanted to distribute from a trust that has made a family trust election across to that company, it would be very difficult for that company to be part of the family group, and therefore we're at very high risk that that distribution will trigger family trust distribution tax at penalty rates. So just something that we come across a fair bit in practice when those companies have been set up with different share classes, or where clients are thinking about issuing a new class of shares. There are lots of issues we need to consider in that case. One of them is the impact that might have in connection with the family trust election rules. So lots and lots of issues. These are just two of the ones that we come across a fair bit in practice, but there's definitely an area we need to be very careful about.
The ATO has also issued a warning to employers about their superannuation guarantee obligation. Michael, what's sparking this?
Yeah, there are two things that come to mind. The first one is remember that the super guarantee rate increases to 11.5% on the 1st of July 2024. This is part of the government's kind of staggered approach to get the SG rate all the way up to 12%, which will come in 12 months' time. But just remember, we've gone from 11 to 11.5% from 1 July 2024. So that will be relevant. Just need to make sure that systems are picking up the right rate as we kind of move into the new financial year. The second thing is we have another SG quarterly contribution deadline coming up soonish. 28 July is the deadline for June quarter amounts. So need to make sure that, again, clients are meeting that deadline, where contributions are being made through different methods. Sometimes there can be a bit of a time lag between kind of sending off a payment and having it actually received by the fund or through a clearinghouse. So again, we just want to make sure that that timing issue is being managed appropriately. Of course, if clients miss that deadline, so if those super guarantee contributions are made late or they're forgotten about or they're missed for whatever reason, a misclassification, for example, we move into the super guarantee charge system automatically. And that's something that we just have to deal with. It's not something the Commissioner has any real discretion around. We move into that system, which means lodging separate statements with the ATO. We're moving into a position where penalties are being applied, interest is being applied. Clients are going to lose deductions as well for those contributions that are missed. So that becomes a very serious problem. So the timing is critical when it comes to the super guarantee system. Probably a lot of you are aware of this, but it might be worth just reminding clients of that as they've got a lot of other things going on. Want to make sure that that deadline is not being missed. It can lead to some pretty nasty outcomes.
So what are the things that we need to be aware of and are especially heightened around this time of the year?
Yeah, there are two things that come to mind. The first one is remember that the super guarantee rate increases to 11.5% on the 1st of July 2024. This is part of the government's kind of staggered approach to get the SG rate all the way up to 12%, which will come in 12 months' time. But just remember, we've gone from 11 to 11.5% from 1 July 2024. So that will be relevant. Just need to make sure that systems are picking up the right rate as we kind of move into the new financial year. The second thing is we have another SG quarterly contribution deadline coming up soonish. 28 July is the deadline for June quarter amounts. So need to make sure that, again, clients are meeting that deadline, where contributions are being made through different methods. Sometimes there can be a bit of a time lag between kind of sending off a payment and having it actually received by the fund or through a clearinghouse. So again, we just want to make sure that that timing issue is being managed appropriately. Of course, if clients miss that deadline, so if those super guarantee contributions are made late or they're forgotten about or they're missed for whatever reason, a misclassification, for example, we move into the super guarantee charge system automatically. And that's something that we just have to deal with. It's not something the Commissioner has any real discretion around. We move into that system, which means lodging separate statements with the ATO. We're moving into a position where penalties are being applied, interest is being applied. Clients are going to lose deductions as well for those contributions that are missed. So that becomes a very serious problem. So the timing is critical when it comes to the super guarantee system. Probably a lot of you are aware of this, but it might be worth just reminding clients of that as they've got a lot of other things going on. Want to make sure that that deadline is not being missed. It can lead to some pretty nasty outcomes.
In cases this month, a taxpayer has successfully fended off an ATO challenge to the valuation of their business. Now, this valuation was used to access CGT concessions. Matthew, what can you tell us about this case?
So just as context, the taxpayer in this AAT case, Maloney, they operated a truck haulage business predominantly in Western Australia, and they specialised in transporting agricultural type products. The taxpayer's advisors, they advised the taxpayer to do a bit of an internal restructure, and what eventually ended up happening was that the taxpayer ended up selling shares in its trading company to a related party within that same economic group as part of this internal restructure. Now, the taxpayer, they went out and did the right thing. They went out and got a valuation which valued the business at around $3.5 million. And they applied the CGT discount as well as the small business CGT concessions to the capital gain. Now, unfortunately for the taxpayer, the ATO, they took a bit of a look at this transaction. They did a bit of an audit, and the ATO went out and got their own separate valuation, which valued the business at around $7 million. Which was double the taxpayer's original valuation. And that fundamentally did two things. The first is that because the ATO didn't think that the parties were dealing with each other at arm's length in relation to the sale, that meant the market value substitution rules applied to increase the capital proceeds to double of what it was originally. The second is that the ATO didn't think that the taxpayer could access or be eligible to access the small business CGT concessions. Because the business was valued at around $7 million, this basically meant that the taxpayer couldn't pass the 6 mil net asset test, which basically requires that the net market value of certain CGT assets of the taxpayer, as well as certain related parties, do not exceed 6 million just before the CGT event. Now, this was a pretty extreme case in the sense that you had two valuations from two experts that were wildly different. One was essentially double the other. While at the same time, and quite perplexingly, the AAT member thought that both experts, they were both qualified, they were both competent, and they were both objective. But the AAT, they need to make a ruling, and the AAT ultimately ruled in favour of the taxpayer, unfortunately for the taxpayer. And they ruled this way because they thought that the taxpayer's valuation took into account of certain things that were a bit more appropriate. So, for example, the taxpayer's valuation took into account of the fact that the taxpayer's business was quite cyclical. So you might remember that the taxpayer's business involved transporting agricultural products. And when it comes to agriculture, you're going to have your good years and you're certainly going to have your bad years if the weather doesn't turn out as well as you'd hope, or when there's some sort of natural disasters or floods that might happen. Then you get your bad years. But more fundamentally, the AAT thought that it was quite appropriate for the taxpayer's valuer to give the market value a bit of a discount to take into effect of the fact that the taxpayer's business was relatively small and that we're dealing with a non-listed entity, which makes it generally a bit harder to sell the shares or to sell the business. But even though the taxpayer did ultimately win at the AAT in this case, it certainly does raise, in this case certainly does raise a couple of concerns.
Why does this raise concerns? Are there other ramifications that this might have in other areas?
Well, it does. So the concept of market value, not only is it relevant in terms of the 6 mil net asset test in the small business CGT concessions, not only is it just relevant for the market value substitution rules when parties aren't necessarily dealing with each other at arm's length, the concept of market value can crop up in a number of different places in the tax provisions. For example, the first use to produce income rule in the main residence provisions, where they can substitute the cost base of a main residence or a previous main residence with its market value when that property is first used to produce assessable income. It can crop up in the employee share scheme provisions, and it can crop up in tax consolidations. And that's just to name a few. In fact, the Inspector General of Taxation, they did a review on market valuations probably about a decade ago now, and they found that the concept of value or market value came up at approximately or around 200 times in the tax provisions. So this does come up, and it can come up quite often, but the problem is that, as we can see in the AAT case, this area is not necessarily black and white. Both taxpayers in the case, they went and sought experts to do a valuation, and they came up with wildly different figures, even though the AAT thought that both experts were qualified and they were competent and they were being objective. And I'm not talking about a 5, 10 or 15% difference. It was something a bit more significant than that, and actually a lot more significant than that. And the problem with things like the small business CGT concessions and that 6 mil net asset test is that it's an all or nothing test. If your client can't pass that 6 mil net asset test and they can't pass the alternative $2 million turnover test, then the small business CGT concessions are simply not available to them. And many practitioners would be aware that the difference between being able to access the small business CGT concessions or not, they can be quite significant. And in some cases, they can be the difference between getting a large capital gain tax bill versus having no capital gains tax liability at all. But the good news is that there are things you can do. Things you can do to manage that risk. Certainly, you can go out and get an independent valuation done. But just like you can with technical issues where you think there might be a bit of uncertainty, you can write into the ATO to get a private ruling on market valuations. You can ask the ATO to do a market valuation. You can ask them to review your valuation, or you can ask them to do a joint valuation. There is a cost to this though, and the ATO will generally charge you a fee for the cost of that valuation, but the benefits in some cases can far outweigh the cost, especially if you're dealing in an area where the value of a particular asset or a particular asset class isn't necessarily that clear, or when you're dealing with an area where there are some significant tax implications if you get it wrong. So again, the classic example are those small business CGT concessions, where it's essentially all or nothing, and the difference between getting it or not can be quite significant in terms of tax implications.
And for those of you contemplating delivering valuation services in your practice, or if you do a few now and you just want to brush up on your skills, don't miss the Business Valuation Workshop, which is on the 15th of June, or starts on the 15th of June. Now that's the roundup for this month. If your firm is not a member of Knowledge Shoppers yet, we'd love to show you what a difference we make to thousands of accountants across the country every single day. Give the team a call or jump onto the website and book in a time to see exactly what we've got on offer. We look forward to speaking to you soon.